How can I implement a jump diffusion model? Are you curious about how to implement a jump diffusion model in options trading? This model adds a layer of realism to option pricing by accounting for sudden price changes in the stock market. Let's break down the steps you need to take to get started. First, you need to understand the key components of the jump diffusion model. The stock price follows a process that combines continuous price movements and random jumps. These jumps are modeled using a Poisson process, which describes how often jumps occur and their sizes. You will need to define several parameters: the current stock price, the strike price of the option, the time until expiration, the risk-free interest rate, the volatility of the stock price without jumps, the jump intensity, the mean jump size, and the jump volatility. Next, you will want to formulate the model. The Merton Jump Diffusion Model is a popular choice. In this model, the option price is calculated as a weighted sum of Black-Scholes prices, adjusted for the number of jumps. The probability of a specific number of jumps happening in a given time frame follows a Poisson distribution. For each possible number of jumps, you will recalculate the volatility and risk-free rate to account for the jumps, and then apply the Black-Scholes formula. Now, let's move on to the practical steps for implementation. Start by defining all your parameters clearly. Decide on a truncation level for the infinite sum over jumps, such as summing up to 20 jumps or until the probabilities become very small. For each possible number of jumps, calculate the Poisson probability. Adjust the volatility and drift terms to include the effects of the jumps. Then, compute the Black-Scholes option price using these adjusted parameters. Finally, sum the weighted prices to arrive at the final option price. You can also use numerical methods and simulations for implementation. Monte Carlo simulation is a flexible approach. In this method, you simulate stock price paths that combine continuous price movements and random jumps. For each simulated path, calculate the option payoff at maturity. By averaging the discounted payoffs across many paths, you can estimate the option price. The jump diffusion model is particularly useful in stock trading and options. It provides more accurate option prices in markets where sudden price moves are common, such as during earnings announcements or significant economic events. This model helps traders assess risk better and price options that show volatility patterns that the Black-Scholes model cannot explain effectively. It is especially beneficial for pricing out of the money options, where jump risk plays a significant role. In summary, implementing a jump diffusion model involves defining jump parameters, combining them with standard diffusion parameters, and calculating option prices through weighted sums or simulations. This model captures real-world price jumps, making it a helpful tool for traders and analysts in the options market.